Ever wondered how much house you can really afford? It's not just about dreaming big, it's about planning smart. In the whirlwind world of home buying, knowing your numbers can make all the difference between a dream home and a financial nightmare. Here's a jaw-dropper. Did you know that in some cities, the cost of a single square foot of housing can be more than your entire week's paycheck? And here's another. While the average size of homes in the US has almost doubled since the 1950s, our buying power hasn't kept pace when you adjust for inflation. But don't let these facts scare you. This journey we're about to take is packed with strategies, secrets, and some surprising truths about what it really takes to afford a home on your salary. From understanding the nitty-gritty of mortgages to decoding the mysteries of down payments, we've got you covered. We'll also dive into the often overlooked costs of homeownership that can catch many buyers off guard. Think property taxes, maintenance, and those pesky utility bills. But it's not all doom and gloom. With the right plan, your dream home is within reach. So, buckle up. We're about to embark on a journey to unlock the door to your future home, equipped with knowledge, strategies, and a dash of reality. Ready to find out how much house you can actually afford? Let's dive in. Chapter 1. The basics of mortgage and home buying. First off, a mortgage is simply a loan from a bank or financial institution to help you buy a house. Think of it as a way to split the cost of your home into manageable monthly payments over several years, usually 15 to 30. The catch? Interest rates. They can change the game. A low rate means lower payments, but they can fluctuate, affecting how much house you can afford. Now, here's a nugget of wisdom. The average mortgage rate has danced around from as low as around 3% to over 18% in the early 80s. Imagine paying more than half your mortgage in interest alone. When you decide to buy a home, your salary steps into the spotlight. Lenders use it to peek into your buying power. It's like your financial fingerprint, unique and telling. But it's not just about how much you make, it's also about how much you owe. Your debts, from student loans to credit card bills, get weighed too. A fun fact to lighten the mood. Did you know people used to have to put down 50% of the home's price as a down payment? Today, it's possible to put down much less, even as low as 3.5% with an FHA loan. Chapter 2. Income versus debt. How lenders assess your affordability. Lenders have a special recipe to figure out if you can afford a mortgage. It's called the debt-to-income ratio, or DTI. They prefer a DTI lower than 43%. It means your debts shouldn't swallow more than 43% of your income. Keep it simple, right? But here's where it gets a tad more interesting. Your salary isn't just a number to lenders. It's a story of your financial health. A stable income suggests you're more likely to keep up with mortgage payments, making you a less risky bet. Have you heard of the term, front-end ratio? It's a piece of the puzzle, focusing on how much of your income goes toward housing costs. The magic number here is 28%. Spend more than that, and lenders might start to frown. Now, let's sprinkle in a surprising fact. Despite what many think, a higher salary doesn't always mean you can afford a more expensive home. Why? Because with great salary comes great responsibility, and sometimes, bigger debts. Chapter 3. The 28-36 rule in home buying. Ever heard of the 28-36 rule? It's like a compass for your finances, guiding you on how much to spend on housing and debt. Simply put, no more than 28% of your gross monthly income should go to housing expenses, and your total debt shouldn't exceed 36%. It's a golden rule that keeps you from drowning in debt while still letting you live comfortably. But why these numbers? They're based on decades of lending experience, showing that people who stick within these limits tend to manage their finances better and avoid the dreaded foreclosure. It's like having a financial safety net. Imagine this. If you're bringing home $5,000 a month, your mortgage, taxes, and insurance shouldn't exceed $1,400. It's a simple guideline that can save you from biting off more than you can chew. Chapter 4. How your salary influences your buying power. Your salary is more than just a number, it's your ticket to home ownership. But it's not just about the total amount, it's about how smartly you use it. High earners can fall into the trap of overspending on homes, while savvy spenders on modest incomes can find gems that fit their budget. Here's something to ponder. The median home price in the US has been rising, but so have incomes, albeit at a slower pace. This gap means your salary's buying power isn't what it used to be, making it more important than ever to shop smart. A fun fact to lighten the load: some of the wealthiest individuals live in homes far below their means. Warren Buffett, for instance, lives in a house he bought in the 1950s for $31,500. It's a testament to living within your means, no matter your salary. And don't forget about down payments. They're your first big hurdle. The more you put down, the less you have to borrow, and the lower your monthly payments. Saving for a hefty down payment, say 20%, can also eliminate the need for private mortgage insurance, PMI, saving you even more. But how do you save for that down payment? It's about setting priorities and sticking to a budget. Even small changes, like cutting back on dining out or picking up a side hustle, can turbocharge your savings rate. Chapter 5. Down payments and their impact on affordability. A down payment is not just the first step into your new home, it's a powerful tool that shapes your financial future. The traditional advice is to aim for 20% of the home's purchase price, which might seem daunting but comes with perks like lower monthly payments and avoiding PMI, a fee that protects the lender, not you, if you default on your loan. Here's a strategy to boost your down payment savings. Automate your savings and consider opening a high-yield savings account specifically for this goal. Even small, regular contributions can grow significantly over time, thanks to the magic of compound interest. Did you know? Some government programs allow first-time homebuyers to put down as little as 3.5%. While this can open doors for many, remember, a smaller down payment means a larger loan and possibly higher monthly costs. Chapter 6. Additional costs of home ownership. Once you've crossed the threshold, the real adventure begins. Homeownership brings with it a treasure trove of additional costs, from property taxes and homeowners insurance to maintenance and repairs. These aren't surprises but certainties that can impact your budget. Property taxes, for example, can vary widely depending on where you live. They fund local services like schools and emergency services, and they can change as your property's value and municipal budgets evolve. It's a recurring cost that deserves a line in your budget. And then there's maintenance. A rule of thumb is to set aside 1% of your home's value annually for upkeep. Whether it's fixing a leaky faucet or replacing a worn-out roof, owning a home means being your own landlord. Utilities are another consideration. Moving from a rental to a larger space? Expect your heating, cooling, and electricity bills to reflect that change. It's not just about the space you're heating or cooling but the efficiency of your home's systems. A unique insight: energy-efficient upgrades can not only reduce your bills but also increase your home's value. It's a win-win that's good for your wallet and the environment. Finally, don't overlook homeowners association (HOA) fees, if applicable. These fees cover the maintenance of common areas and, sometimes, amenities like a pool or gym. While they can add value to your living experience, they're also a fixed monthly expense. In wrapping up these chapters, the takeaway is clear. Buying a home is about more than just the mortgage. It's a commitment that comes with a spectrum of financial responsibilities. But with careful planning and a realistic budget, the dream of homeownership can be a rewarding reality.